Most traders think success comes from finding the right day to trade. The truth is often the opposite. A large part of long-term success comes from recognizing the days you should stay out of the market entirely. Not because you're afraid, not because you're uncertain, but because the conditions are working against clear decision-making. Today, I want to show you 3 signs that you should not trade, and the first one has nothing to do with the market. It has everything to do with you. If you sit down at your screen carrying frustration, impatience, or the need to recover yesterday's losses, what do you think happens to your judgment? Most traders believe emotions affect execution after a trade is entered. In reality, emotions influence the trade selection itself. They change what you see. A mediocre setup suddenly looks attractive. A weak signal appears convincing. The market hasn't changed. Your perception has. When your emotional state is driving your decisions, you're no longer reading the market. You're negotiating with your feelings. And that's a dangerous position to trade from. So before looking at a chart, ask yourself a simple question. Am I trying to make money, or am I trying to feel better? The answer tells you more than any indicator. The second sign is when nothing is standing out. Now, this is where many traders make a costly mistake. Have you ever spent an hour scanning charts, searching for an opportunity, convincing yourself that there must be something worth trading? That urge is understandable. But think about what it's really telling you. The best opportunities tend to attract your attention naturally. They have clarity. They separate themselves from the noise. When you're forcing a trade idea into existence, you're often compensating for the absence of a genuine edge. And here's the important part. The market does not pay you for activity. It pays you for accuracy. When conditions are unclear, patience becomes a trading decision. Sometimes the highest quality trade is the one you never take. Which brings us to the third sign. Your recent behavior is becoming reckless. Maybe you've increased position size without a clear reason. Maybe you're taking setups outside your plan. Maybe you're entering trades simply because you don't want to miss a move. Sound familiar? These behaviors rarely appear suddenly. They usually begin after a series of wins that create overconfidence, or a series of losses that create urgency. Different emotions, same outcome. Discipline starts to weaken, and once discipline weakens, risk expands faster than most traders realize. The danger isn't the next trade. The danger is what that next trade represents. Because every time you ignore your process, you teach yourself that rules are optional. And when rules become optional, consistency disappears. So watch for these 3 signs. An emotional mindset, a market offering no obvious opportunities, and behavior that is drifting away from your plan. Notice the pattern. None of them are really about predicting price. They're about protecting judgment. Because the traders who survive long enough to win understand something that beginners often miss. Your first responsibility is not finding opportunity. Your first responsibility is preserving the ability to recognize opportunity when it finally appears. Most traders wake up with the same assumption. The market is open, so there must be money to make. It sounds reasonable. After all, prices are moving, volume is flowing, and opportunities seem to be everywhere. But this belief quietly pushes traders into one of the most expensive habits in the business, feeling obligated to participate. Let me ask you something. Have you ever sat down at your screen with the intention of finding a trade no matter what? Not because a great opportunity was obvious. Not because your setup was staring you in the face. Simply because you showed up and felt like you should do something. That's where the trouble begins. The market opens every day, but it doesn't offer high-quality opportunities every day. Those are 2 completely different things. Many traders treat market hours like business hours. They believe that if the market is operating, their job is to trade. But the professionals who last for decades often think differently. Their job is not to trade. Their job is to wait for moments when risk and opportunity are aligned. There's a subtle difference there, but it changes everything. When you believe you must trade, patience becomes impossible. Every chart starts looking attractive. Every small movement appears meaningful. Every signal feels stronger than it really is. Why? Because the mind begins searching for confirmation rather than truth. Instead of asking, "Is this a great trade?" you start asking, "Can I justify taking this trade?" And those are very different questions. The market has a way of punishing traders who force participation. Not immediately, which makes the lesson harder to learn. Sometimes a forced trade even makes money. That creates the illusion that the decision was correct. But profitable mistakes are still mistakes. Over time, the habit grows. You stop waiting for clear conditions. You stop demanding quality. You lower your standards little by little until activity becomes more important than selectivity. Think about a fisherman. Does he throw his net into every patch of water he sees? Of course not. He understands that location matters, timing matters, conditions matter. Trading is no different. The market may be open, but favorable conditions are not always present. Volatility changes, trends weaken, liquidity shifts, market participants become uncertain. What worked yesterday may have no edge today. Yet many traders ignore these realities because sitting still feels uncomfortable. Why is that? Because inactivity often feels like failure. You spend time preparing. You wake up early. You study charts. You analyze news. Then you sit there and do nothing. To the inexperienced trader, that feels unproductive. To the experienced trader, that can be a sign of discipline. The ability to do nothing when nothing deserves action is one of the most valuable skills in speculation. And it's also one of the rarest. Most people are trained to associate effort with reward. Work harder, get more results. Trading doesn't always operate that way. Sometimes the trader who takes 10 trades loses money. The trader who takes 1 trade makes money. The difference is not effort. The difference is selection. So the next time you open your platform, ask yourself a simple question. Am I seeing an opportunity, or am I looking for an excuse to participate? That question can reveal a lot. Because the market doesn't care that you're ready. It doesn't care that you've been waiting all morning. It doesn't care that you want action. The market offers opportunities on its schedule, not yours. And the traders who understand this stop treating every trading day as an obligation. They stop viewing market access as a command to act. They recognize that being present and being invited are not the same thing. Just because the doors are open doesn't mean conditions are favorable. Just because prices are moving doesn't mean an edge exists. And just because everyone else is trading doesn't mean you should be joining them. One of the most dangerous moments in trading is not when you're losing money. It's when you feel a growing sense of urgency. At first, it doesn't seem like a problem. In fact, it often feels productive. You become more focused, more determined, more eager to make something happen. But beneath the determination, something important has changed. Your attention is no longer centered on the market. It's centered on an outcome. Let me ask you something. Have you ever looked at a chart after a losing streak and thought, "I need a good trade today"? That thought sounds harmless, almost responsible. But the moment you need something from the market, your judgment begins to shift. Because now you're not evaluating opportunities objectively. You're searching for a solution to a problem, and urgency has a strange effect on the mind. It compresses time. A trader who was willing to wait for the perfect setup yesterday suddenly becomes impatient today. A setup that would normally be ignored now looks acceptable. A trade that once seemed risky now feels necessary. Why? Because urgency changes the standard. When you're calm, you evaluate quality. When you're urgent, you evaluate possibility. That's a major difference. A calm trader asks, "Does this fit my plan?" An urgent trader asks, "Could this work?" The second question opens the door to endless mistakes. The market is full of trades that could work. What matters is whether they deserve your capital. This is where many traders get trapped. They believe their losses came from not trading enough. So they increase activity. They take more setups. They force more entries. They try to create results through effort. But trading isn't a profession where more action automatically creates better outcomes. In fact, the opposite is often true. The harder you try to force profits, the further they seem to move away. Think about what happens after a few losses. Your confidence drops. Your patience weakens. Your focus narrows. Suddenly, every candle feels important. Every breakout looks promising. Every small movement feels like the beginning of a major opportunity. The market hasn't become clearer. You've become more desperate for certainty, and desperation is expensive. Not because it guarantees losses, but because it encourages poor decision-making. The trader begins entering too early, exiting too late, increasing position size, ignoring warning signs, breaking rules that were once followed without hesitation. The most dangerous part is that urgency rarely announces itself. It disguises itself as motivation. You tell yourself you're being aggressive. You tell yourself you're staying engaged. You tell yourself you're refusing to quit. But if that energy is pushing you away from your process, it's not helping you. It's hurting you. Professional traders understand something that many beginners miss. The market rewards discipline far more consistently than determination. Determination can help you study. It can help you prepare. It can help you improve. But once the trading session begins, discipline matters more. Because discipline allows you to wait. Discipline allows you to pass on mediocre opportunities. Discipline allows you to remain patient when nothing deserves action. Urgency does the opposite. It creates pressure, and pressure creates shortcuts. Have you ever noticed how your best trades often happen when you feel relaxed? You're not chasing. You're not forcing. You're simply responding to what the market is offering. The setup appears. The conditions align. The decision becomes clear. That's because clear thinking requires emotional space. Urgency takes that space away. The moment you feel like something must happen today, you should pay attention. Because the market doesn't know your goals. It doesn't know your losses. It doesn't know how badly you want to recover, prove yourself, or hit a target. Price will move according to its own forces, completely indifferent to your timetable. And the trader, who allows urgency to dictate decisions, eventually finds himself fighting reality instead of reading it. Boredom has emptied more trading accounts than most people realize, not because boredom is powerful by itself, but because of what it quietly convinces traders to do. Most people enter the market expecting action. They imagine fast decisions, constant opportunities, and endless movement. Then reality arrives. The market slows down. Price drifts sideways. Nothing stands out, and suddenly, sitting still becomes uncomfortable. Have you ever stared at your screen for an hour and felt the urge to take a trade simply because nothing was happening? If so, you're not alone. Almost every trader experiences this at some point. The problem is that boredom creates a dangerous illusion. It makes inactivity feel wrong. You begin thinking that because you're not trading, you're not working. Because you're not involved, you're falling behind. Because you're waiting, you're missing opportunities. But none of those assumptions are necessarily true. In fact, they often lead traders directly into poor decisions. Think about what happens when boredom takes control. You start scanning more aggressively. You zoom into smaller time frames. You begin noticing patterns that didn't matter before. A minor price movement suddenly looks significant. A weak setup starts appearing attractive. A random fluctuation begins to resemble opportunity. Why? Because the mind dislikes empty space. When there's no obvious opportunity, many traders don't accept that reality. They try to fill the gap, and that's where trouble begins. The market doesn't reward participation. It rewards judgment. Those are not the same thing. A bored trader often mistakes activity for productivity. He feels better after entering a position because he's finally doing something. But feeling productive and being productive are very different experiences. The trade may have no edge. The conditions may be poor. The risk may be unnecessary. Yet the simple act of entering a position creates temporary relief. That's what makes boredom so deceptive. The trade isn't solving a market problem. It's solving an emotional problem. The trader wants stimulation. The trader wants engagement. The trader wants movement. And once those desires enter the decision-making process, objectivity begins to disappear. Let me ask you another question. Have you ever reviewed a losing trade and realized you probably wouldn't have taken it if you had been busy doing something else? That's a revealing observation. Because many unnecessary trades are not driven by analysis. They're driven by the inability to tolerate waiting. The best traders understand something that takes years for many people to learn. There is a difference between watching the market and needing something from the market. One is observation. The other is dependence. When boredom appears, the temptation is to create excitement through action. But experienced traders often do the opposite. They step back. They reduce screen time. They protect themselves from the urge to manufacture opportunities, because they understand a simple truth. If a setup is truly exceptional, it usually doesn't need to be forced into view. It tends to reveal itself naturally. The clearer the opportunity, the less convincing it requires. The weaker the opportunity, the more stories traders invent to justify it. That's why boredom and overtrading are closely connected. One creates discomfort, the other offers temporary relief. The cycle becomes easy to understand. Nothing happens. Boredom increases. Patience decreases. Standards drop. A trade is taken. And suddenly the trader feels engaged again. The problem is that engagement came at the cost of quality. Over time, this habit becomes expensive. Not because every boredom trade loses money. Some of them win. That's what makes the habit difficult to recognize. A few random winners can reinforce behavior that has no real edge. The trader starts believing the decision was good because the outcome was favorable. But successful trading isn't about finding ways to stay entertained. It's about finding ways to stay selective. The market offers endless opportunities to act. Far fewer opportunities to act wisely. Some of the most expensive trades are not the ones that lose. They're the ones that never should have been taken in the first place. A forced trade often looks normal from the outside. The chart appears reasonable. The entry may even seem logical. If you showed it to someone else, they might not immediately see the problem. But the problem isn't always on the chart. The problem is usually in the decision process. Let me ask you something. Have you ever spent 20 minutes trying to convince yourself that a setup was good enough? Not great. Not obvious. Just good enough. That moment deserves attention. Because truly high, quality opportunities rarely require negotiation. You don't have to talk yourself into them. You don't have to build a complicated case for why they might work. The market presents them clearly enough that the decision feels straightforward. Forced trades are different. They often begin with a desire rather than an observation. You want a trade. Then you start looking for reasons to justify one. Notice the order. The conclusion comes first. The evidence comes second. And that's where judgment begins to break down. The mind is remarkably good at finding support for what it already wants to believe. If you want to buy, you'll notice bullish signals. If you want to sell, you'll find bearish signals. If you want action, you'll discover opportunities everywhere. The chart hasn't changed. Your interpretation has. This is why forced trades can be so dangerous. They create the illusion of analysis while bypassing true objectivity. A trader feels disciplined because he's looking at indicators, drawing levels, and reviewing price action. But beneath all that activity, the outcome was already chosen. The analysis became a search for confirmation. Have you ever noticed how easy it is to find reasons for a trade when you're eager to take one? Suddenly every technical signal seems meaningful. Every news headline appears relevant. Every market movement feels like validation. What would normally be viewed as uncertainty gets interpreted as opportunity. That's not market insight. That's emotional filtering. And emotional filtering usually becomes expensive. The market doesn't punish forced trades immediately every time. In fact, that's part of the problem. Some forced trades make money. A trader ignores his standards, enters a mediocre setup, and walks away with a profit. Now a dangerous lesson has been learned. The trader begins to believe that discipline is optional, that shortcuts are acceptable, that standards can be relaxed. But over time, probabilities always reveal themselves. One forced trade becomes 5. 5 become 20. The edge slowly disappears because the trader is no longer selecting opportunities. He's manufacturing them. Think about a hunter. Does he fire at every movement he sees? Of course not. He waits, he observes. He understands that patience improves accuracy. Trading works the same way. Every unnecessary trade consumes capital, attention, and emotional energy. Many traders focus entirely on financial risk. They rarely think about mental risk. But every poor decision weakens confidence. Every forced entry creates doubt. Every unnecessary position adds stress. And stress affects future decisions. One low-quality trade often leads to another. A loss creates frustration. Frustration creates urgency. Urgency creates even lower standards. The cycle feeds itself. This is why successful traders become extremely selective. Not because they enjoy missing opportunities, not because they're afraid, but because they understand that quality matters more than quantity. The goal is not to find a reason to trade. The goal is to find a reason not to trade until a truly compelling opportunity appears. That's a very different mindset. Most people enter the market asking, "What can I trade today?" Experienced traders often ask, "What deserves my capital today?" One question encourages activity, the other encourages judgment. And when you begin paying attention to your decision process, you'll notice something interesting. The trades that require the most convincing are often the trades that create the most regret. Most traders begin their day by looking at charts. They check price action. They analyze levels. They review news. They search for opportunities. All of that seems logical. But there's something far more important that often gets ignored: the condition of the person looking at those charts. Before you read the market, you should learn to read yourself. Because no chart, no indicator, and no strategy can protect you from a mindset that is working against you. Let me ask you something. Have you ever looked back at a trade and wondered how you ever thought it was a good idea? At the time, the decision felt reasonable. The setup seemed convincing. The risk appeared manageable. Yet later, with a clear mind, the flaws became obvious. What changed? Usually it wasn't the chart. It was your state of mind. Trading is unique because every decision passes through a psychological filter. Two traders can look at the exact same market and reach completely different conclusions. Why? Because they are not just seeing price. They are seeing price through their emotions, expectations, fears, and desires. A trader who is calm notices information. A trader who is frustrated searches for solutions. A trader who is fearful searches for safety. A trader who is overconfident searches for confirmation. The market stays the same. The interpretation changes. That's why your mindset is the first chart you should read every day. If your emotions are unstable, your analysis becomes unstable. The connection is stronger than most people realize. Think about what happens after a large loss. Your confidence takes a hit. Now every setup feels questionable. You hesitate. You second guess. You miss opportunities because fear has become part of the decision process. Now consider the opposite situation. You experience a series of successful trades. Confidence grows. Then confidence slowly turns into certainty. Risk starts increasing. Rules become flexible. Warnings are ignored. The same market that looked dangerous a week ago suddenly looks easy. Again, the market hasn't changed. Your mindset has. This is why many trading mistakes occur before the trade is ever placed. The error begins in perception. When emotions influence perception, they influence everything that follows: entry selection, position sizing, risk management, trade management, even how you interpret outcomes. A trader in the wrong mindset can lose money with a good strategy. A trader in the right mindset can often avoid serious damage even during difficult periods. Have you ever noticed how some days feel unusually difficult? Not because the market is confusing, because your mind feels crowded. Maybe you're distracted by problems outside trading. Maybe you're thinking about recent losses. Maybe you're focused on a profit target you desperately want to reach. Whatever the reason, concentration becomes fragmented. And when concentration weakens, discipline usually follows. This is where self-awareness becomes a competitive advantage. Most traders spend years studying markets. Far fewer spend time studying themselves. Yet your emotional patterns often repeat more consistently than market patterns. The same impatience appears. The same frustration appears. The same overconfidence appears. Different days. Different charts. Same behavior. Once you begin recognizing those patterns, you gain something valuable. You gain the ability to intervene before mistakes happen. Instead of reacting to poor decisions, you start preventing them. A simple mental check can reveal a lot. Are you calm? Are you patient? Are you objective? Or are you looking at the market through the lens of fear, frustration, boredom, or urgency? These questions matter because your mindset doesn't just influence trading performance. It determines how information is processed. And when information is processed incorrectly, Even the best opportunities can be misunderstood. Many traders spend their mornings searching for signals on charts. One of the fastest ways to damage your trading is to believe that today must be profitable, not because making money is wrong. Every trader is here to make money. The problem begins when profit stops being a goal and becomes a requirement. There's a big difference between wanting a profitable day and needing one. Have you ever started a trading session thinking, I have to make money today? Maybe you were trying to recover a recent loss. Maybe you wanted to hit a weekly target. Maybe you simply felt frustrated because results hadn't been coming fast enough. Whatever the reason, that thought changes the way you interact with the market, and, rarely for the better. The moment profit becomes a necessity, patience starts to disappear. You stop evaluating trades based on quality. You start evaluating them based on potential reward. That shift may sound small, but it changes everything. A disciplined trader asks, is this setup worth taking? A trader who needs profit asks, can this make me money? Those questions lead to very different decisions. The first protects capital. The second often exposes it. The market has an interesting way of testing traders. It doesn't care about your daily goals. It doesn't care about your monthly targets. It doesn't care how much money you lost yesterday or how much money you hope to make today. The market moves according to its own conditions. Some days offer excellent opportunities. Other days offer very little. Yet many traders show up with the expectation that profits should be available on demand. When reality doesn't cooperate, frustration begins to build, and frustration rarely stays isolated. It spreads into decision-making. You start entering trades earlier than planned. You hold losing positions longer. You become more willing to overlook weaknesses in a setup. Why? Because the focus is no longer on execution. The focus is on achieving an outcome. That's where danger enters. Trading is one of the few professions where pursuing the outcome directly often makes the outcome harder to achieve. Think about a professional athlete. Can they control the final score? Not completely. What they can control is preparation, discipline, and execution. Trading works the same way. You cannot control whether today's market provides opportunity. You cannot control whether a valid setup wins or loses. What you can control is the quality of your decisions. The irony is that traders who become obsessed with daily profits often make less money over time. Why? Because they begin forcing situations that don't deserve action. The need for results creates pressure. Pressure creates emotional decisions. Emotional decisions create inconsistency, and inconsistency eventually damages performance. Have you ever noticed how some of your best trades happened when you weren't thinking about the money? You were focused on the setup, focused on the process, focused on following your plan. The trade unfolded naturally because your attention was in the right place. Now compare that to the days when you desperately wanted profits. Every tick mattered. Every pullback felt threatening. Every trade carried emotional weight. The experience felt heavier because your expectations were heavier. The market didn't become more difficult. Your relationship with the outcome changed. This is why experienced traders often measure success differently. They don't judge a day solely by profit or loss. They judge it by the quality of execution. Did they follow their rules? Did they manage risk properly? Did they remain patient? Did they avoid forcing trades? These questions matter because profitable trading is usually a byproduct of good behavior, not the direct result of chasing money. When traders focus exclusively on profits, they often sacrifice the very behaviors that produce those profits. The need to win today becomes stronger than the commitment to trade well today. And that's a costly trade-off, because the market has a way of exploiting emotional urgency. The harder you demand money from it, the more likely you are to abandon the discipline required to earn it. One of the most expensive mistakes a trader can make is confusing market noise with opportunity. At first glance, they can look remarkably similar. Both involve movement. Both involve price changes. Both can create excitement. But only one deserves your capital. Let me ask you something. Have you ever watched a chart for long enough that every move started feeling important? A small breakout catches your attention. A quick pullback seems meaningful.